Have you ever noticed that the more cash you earn, the faster it seems to disappear? It shouldn't work that way. If earning more money automatically created financial security, every promotion would permanently improve your life. Every raise would reduce your stress, and people with six-figure incomes would never worry about paying bills. Yet millions of them do. They earn more than they ever imagined, but they still feel one unexpected expense away from financial panic. So where does all the cash go? The answer isn't hiding in your paycheck. It's hiding inside an invisible system that quietly changes the way your brain thinks about money every time your income grows. Once you see that system, you'll never look at cash the same way again. Imagine two friends who each receive a $30,000 raise on the same day. They celebrate together, promise themselves they'll finally get ahead, and genuinely believe their financial worries are over. 5 years later, one has built a six-figure investment portfolio, has 6 months of expenses saved, and could leave a stressful job tomorrow if they wanted. The other has a larger house, a newer SUV, premium subscriptions, and barely enough cash to reach the next payday. They earned exactly the same extra income. So why did they end up with completely different lives? Most people would say one was simply better at budgeting. Others would say one had more discipline. Both answers sound reasonable, but they miss the real story. Long before either person spent a single dollar, their brains had already decided what that money was supposed to do. That's the hidden side of money almost nobody talks about. Financial success isn't determined only by how much you earn. It's determined by the invisible rules your mind follows after the money arrives. Your brain was never designed to build wealth. It was designed to keep you alive. Thousands of years ago, having extra resources increased your chances of surviving the next winter or the next failed hunt. Running out of resources wasn't uncomfortable. It was dangerous. Although the world has changed dramatically, your brain still responds to financial uncertainty as if survival is at stake. A shrinking bank balance doesn't just feel inconvenient. It feels threatening. That ancient survival instinct quietly shapes modern financial behavior. Every time your available cash drops below what your brain considers safe, it becomes harder to think about the future. Suddenly, long-term investing feels less important than immediate comfort. Saving becomes something you'll start next month. Paying yourself first becomes something you'll do after the next raise. Without realizing it, your time horizon begins shrinking along with your cash reserves. Psychologists call part of this present bias. We naturally give more weight to immediate rewards than future benefits because today's problems feel real while tomorrow's opportunities feel distant. That's why buying a new phone today feels exciting, while investing the same money for retirement feels almost invisible. The emotional reward arrives immediately, but the financial reward requires patience, and your brain rarely treats those two outcomes equally. Then something even more subtle begins happening. As your income increases, your definition of a normal life quietly expands with it. The apartment you once dreamed about becomes your new baseline. The occasional restaurant becomes a weekly routine. The streaming service you once questioned becomes an automatic renewal you barely notice. None of these decisions feel extravagant on their own, but together they slowly reshape your financial life. This is called hedonic adaptation, and it may be one of the most powerful forces working against long-term wealth. Human beings are remarkably good at adapting to improvement. What once felt luxurious eventually feels ordinary. The excitement fades, but the monthly payment remains. Before long, the lifestyle that once represented success begins feeling completely normal, and your brain starts searching for the next upgrade that promises the same feeling. Here's where the mathematics quietly enters the story. Imagine your promotion gives you an extra $600 every month. You decide you've earned a nicer lifestyle, so that money disappears into a larger car payment, more expensive holidays, premium subscriptions, and frequent dining out. Another person receives the exact same raise, but automatically invests the entire $600 every month into a diversified portfolio, earning an average annual return of 8%. At the end of the first month, there appears to be almost no difference between them. After the first year, the gap still feels surprisingly small. This is why so many people underestimate compound growth. It moves quietly before it moves dramatically. But 40 years later, the investor has accumulated more than $1 million, while the spender owns memories, habits, and possessions that have largely depreciated or disappeared. The monthly decision looked insignificant. Time transformed it into one of the biggest financial decisions of their entire life. That is the hidden mathematics of opportunity cost. Every dollar can only live one future. It can buy comfort today, or it can buy freedom tomorrow. It cannot do both simultaneously. Every purchase carries an invisible price that never appears on the receipt, because the real cost is measured by what that money could have become if it had continued working instead of being consumed. Most people never perform that calculation because our brains aren't naturally wired to imagine invisible futures. We compare purchases with today's bank balance rather than tomorrow's possibilities. We ask, can I afford this? Instead of asking, what is this dollar giving up over the next 30 years? That small change in perspective separates spending decisions from wealth-building decisions. Now another hidden system begins to reveal itself. People often believe they need more cash because life keeps getting more expensive. While inflation certainly matters, something else is usually happening at the same time. Every raise quietly invites new financial commitments: a larger mortgage, a financed vehicle, higher insurance premiums, more subscriptions, more recurring expenses that permanently claim future income before that income has even arrived. You don't simply spend more money. You reduce tomorrow's flexibility. This creates what could be called the cash dependency loop. Higher income encourages a higher lifestyle. A higher lifestyle creates higher fixed expenses. Higher fixed expenses reduce available cash. Reduced cash increases financial anxiety. Anxiety makes immediate comfort feel even more valuable, encouraging even more spending. The cycle repeats so gradually that most people never notice they're running faster just to remain in the same emotional place. Now think back to those two friends from the beginning. The difference wasn't intelligence. It wasn't luck. It wasn't even income. It was financial margin. Financial margin is the space between what you earn and what your life demands from you every month. It is the breathing room that allows you to make decisions without panic. Ironically, financial margin often matters far more than salary because it determines whether unexpected events become inconveniences or full-scale financial emergencies. Imagine two households earning exactly $120,000 each year. One spends almost everything they earn and finishes each month with only $1,000 available. The other deliberately maintains lower fixed expenses and keeps a $30,000 emergency fund. Then both households lose their primary source of income. The first family immediately begins worrying about mortgage payments, loan repayments, and credit card bills. Every decision becomes urgent because time is running out. The second family faces the same setback, but something remarkable happens. Their emergency fund buys something far more valuable than money. It buys time. If their monthly expenses are $5,000, then a $30,000 emergency fund has already purchased 6 months of freedom. 6 months to search for the right job instead of accepting the first offer. 6 months to avoid high-interest debt. 6 months to make thoughtful decisions instead of desperate ones. This is why cash is so misunderstood. Many people see cash sitting in a savings account and assume it isn't doing anything productive. But cash performs one of the most valuable jobs in personal finance. It protects your future from becoming controlled by your next emergency. It gives you options when life becomes unpredictable. Cash creates optionality. Optionality is the ability to choose instead of react. It allows you to invest during market crashes while others are forced to sell. It allows you to leave unhealthy workplaces without immediately fearing bankruptcy. It allows you to negotiate from confidence instead of desperation. The greatest value of cash isn't what it buys. It's the choices it preserves. Of course, this doesn't mean every dollar should remain in cash forever. Inflation quietly reduces purchasing power over time, meaning cash should have a purpose. Some dollars should protect your future through an emergency fund. Others should build wealth through long-term investing. The mistake is allowing every dollar to disappear into consumption before it has the opportunity to perform either job. Escaping this trap doesn't require extreme frugality or giving up everything you enjoy. It requires changing one simple question. Instead of asking, how much more money do I need? Start asking, how much more freedom can this dollar create? Before increasing your lifestyle, increase your investments. Before upgrading your car, strengthen your emergency fund. Before adding another monthly payment, ask whether you're purchasing convenience or quietly selling a piece of your future flexibility. Eventually, something remarkable begins to happen. You stop feeling like you're constantly chasing more cash because your financial system stops consuming every dollar before it arrives. Financial stress gradually gives way to financial confidence, not because you suddenly became rich, but because you've created enough margin for money to work for you instead of against you. So the next time you catch yourself saying, "I just need more cash," pause for a moment. Maybe you don't need more money. Maybe you need more margin. Because wealth isn't created by how much flows into your life. It's created by how much freedom remains after every dollar has been given a job. Remember, wealth isn't just about numbers. It's about understanding the unspoken side of money. If this video changed the way you think about cash, tell us in the comments what financial habit has created the most freedom in your life. If you enjoyed this documentary, leave a like, subscribe to Unspoken Finance, and join us as we continue uncovering the hidden psychology, invisible systems, and real mathematics behind everyday money decisions.